Okay, picture this. It's the 1980s in America. Corporate boardrooms, usually these, quiet places for strategy talks, suddenly they feel more like war rooms.
Mm-hmm.
Executives aren't just thinking about new products or markets. They're actually looking over their shoulders, waiting for an attack.
Yeah, a different kind of attack.
Exactly.
Yeah.
Not from a competitor with a better mousetrap. This was finance being used like a weapon, aimed right at the company's core.
It really was. This was the time when these figures, people called them Black Knights or corporate raiders, burst onto the scene.
Right.
And they saw these huge established companies not as, well, long-term projects to build up, but more like intricate machines. Machines they could buy, tinker with, rearrange the parts, and make a lot of money from, often incredibly fast.
It sounds like a fundamental shift in how business was done.
Oh, absolutely transformative for the financial world.
Yeah.
For a long time, M&A, mergers and acquisitions, they were mostly friendly deals, strategic, two companies deciding, yeah, we're better off together.
Makes sense.
But the 80s, boom, this dramatic, really jarring move towards hostile takeovers, involuntary bids. The target company's management, they absolutely did not want to sell.
And it wasn't about synergy, like putting two companies together to make something better operationally.
Not necessarily. As the sources we looked at point out, it wasn't always driven by that kind of industrial logic. It was often purely about financial maneuvering.
The financialization of takeovers, I think I've heard that term. Like, it's not about making better widgets, it's about the balance sheet itself being the prize.
Precisely. Looking at a company and thinking, those assets look interesting. I can leverage that. I can restructure that debt. It's a finance play.
And what was the key tool? How did they pull off these massive unwanted acquisitions?
The real engine, the thing that powered so many of these hostile deals, was this financing strategy called bootstrap debt financing.
Bootstrap debt.
Yeah. Forget needing, billions in cash sitting around. The big innovation, or maybe the problem, depending on how you look at it, was using the target company's own assets as the security for the loan needed to buy it.
Wait, run that by me again. So I want to buy company X worth $1 billion. I don't have $1 billion. I borrow it.
Yeah.
But the loan is backed by company X's factories and assets, not mine.
You got it.
Yeah.
It's like using the house you want to buy as the collateral for the mortgage you need to actually buy that house from the people living there.
Wow.
You gain control, you close the deal, and bam, the company you just bought is suddenly drowning in the debt you took out to acquire it.
It sounds risky. For the company, anyway.
It was revolutionary because it enabled deals on a scale that was just unimaginable before for many players. But yeah, the consequences for the target companies, they could be pretty severe.
What did that look like in practice, based on the sources?
Well, once the raider, the Black Knight, got control, the number one priority was usually servicing that massive debt load they just layered onto the company, and of course, generating quick returns for themselves.
Right, got to pay back the loan and make a profit.
Exactly. So the sources detail these common outcomes. You'd often see lucrative, immediate payouts to the buyers. Basically, pulling cash right out of the company's reserves almost immediately.
Like raiding the corporate piggy bank the moment you get the keys.
Kind of, yeah. And then to keep making those debt payments and lock in profits quickly, the new owners would frequently start dismantling the company, selling off divisions, real estate, valuable assets, anything that could bring in quick cash.
So breaking it up for parts.
Often, yes. And this wasn't usually careful strategic pruning for the long term. It was often more like a rapid-fire sale just to meet those financial obligations.
Which has got to impact the core business that's left.
Absolutely. And servicing all that debt meant slashing future investment. Things like R&D, capital expenditures, stuff companies need to innovate and grow down the road. That often got cut dramatically to free up cash flow.
Makes sense in the short term, maybe boost profits on paper for a bit.
But it could cripple the company's ability to compete in the future. And, maybe the most visible impact, it frequently led to major job cuts. Closing plants, shutting down facilities. That hit not just the employees, but entire communities sometimes.
So when the sources talk about the sinister goals of these Black Knights, that's what they mean. This focus on quick financial extraction, even if it meant dismantling the company and job losses instead of long-term building.
That's definitely a central part of the critique, yes. The whole focus shifted away from managing a sustainable business with lots of stakeholders and your employees, customers, suppliers, the local town, towards just maximizing financial value for the new owners and whoever held the debt.
And Marty Lipton, the lawyer you mentioned earlier, he was a big critic of this.
He was a major voice pushing back. He saw this whole trend as incredibly dangerous short-termism, just focusing on the present, sacrificing the future. He had this really powerful analogy. He compared it to a farmer.
A farmer? How so?
Yeah, he said, imagine a farmer who, instead of tending the land properly, rotating crops, investing in soil health for the long haul, just tries to extract the absolute maximum yield this year.
Just drains the soil for immediate profit.
Exactly. Makes a ton of money right away, maybe. But Lipton's point was inevitably that leads to disaster, a dust bowl. The farm collapses, the community suffers. He saw the same destructive pattern in these hostile takeovers, sacrificing the company's long-term health and viability for that quick, short-term financial gain.
That's a stark analogy. And you mentioned earlier, it wasn't just the tactics, but the sheer scale of these deals that was shocking.
The scale was off the charts. Lipton pointed out before about 1981 the idea of a billion-dollar hostile takeover bid. It was almost science fiction. Suddenly you had multi-billion-dollar bids happening. And crucially, they were getting financed.
So the money was there.
The money was suddenly available, thanks in part to things like that bootstrap financing and, as we'll discuss, junk bonds. This completely changed the game. For decades, big companies felt, well, somewhat safe just because they were huge. Size was a defense.
Too big to swallow.
Right. But in the 1980s, that defense just evaporated. Size alone wasn't enough anymore. Massive corporations, household names, companies people thought were untouchable, suddenly found themselves in the crosshairs. It fundamentally altered the strategic thinking for pretty much every public company in America.
Okay, so we have this aggressive new playbook. Hostile bids, tons of debt backed by the target's assets, focus on quick value extraction. And even giant companies are vulnerable. Who are the people actually running this playbook? Let's put some names to these corporate raiders and black knights.
Right. It's good to clarify the terms a bit, as the sources sometimes do. A black knight specifically is the company or group making that unwelcome, hostile bid. Management doesn't want them. They see their goals as destructive. Pretty much. A corporate raider is a bit broader. It's the term for the investors, the individuals, the firms known for pursuing these types of hostile takeovers, especially really active in the 70s, 80s, and into the 90s. They were the masterminds, the financiers behind the bids.
And they became pretty famous, or maybe infamous.
Oh, absolutely. Highly visible, often very controversial figures. The sources we reviewed mention names like Boone Pickens, Carl Icahn, Victor Posner, Ronald Perelman. There were others, too. They weren't just financiers. They were personalities. Big egos, big headlines.
And their main goal, as you said, wasn't necessarily building a better widget company. It was about the financial outcome.
That's the core characteristic and also the core criticism you hear. The primary objective was usually making money quickly, either from the deal itself or from breaking up the company afterwards or forcing management to make changes that boosted the stock price short term so they could sell out.
So what kind of companies did they target?
They looked for companies they thought the market was undervaluing. Or maybe companies they saw as bloated, poorly managed, maybe with too many costs. Sometimes companies they thought could be run more profitably, if taken private, away from public shareholders and quarterly reporting pressures.
And the plan was either fix it fast or strip it down.
Pretty much. Force management to make rapid changes to unlock that perceived value, boost the stock, get out quick, or take control themselves and just start selling off the valuable pieces, the assets, for profit.
Let's look at a couple of specific examples from the sources. Victor Posner is mentioned as an early figure.
Yes, Posner is interesting. He's sometimes credited with really popularizing, maybe even coining, the term leveraged buyout, the LBO. He made his first fortune in real estate. Then in '66, he got control of DWG Corporation.
Okay.
And he used DWG basically as his personal piggy bank, an investment vehicle to buy stakes in lots of other companies.
Yeah.
One of the really early kind of proto-hostile takeovers mentioned is his battle for Sharon Steel back in 1969.
So way before the 80s boom.
Yeah, he was an early mover. And his signature strategy was always heavy debt, using borrowed money to make acquisitions. Now, that can juice returns if things go well.
But it adds a lot of risk.
Tremendous risk. And in the Sharon Steel case, that heavy debt load was a major factor when the company eventually filed for bankruptcy in 1987. So it was an early warning sign, really, about the potential dangers of that super aggressive, high leverage model.
Right. Now, Probably the name most people associate with the 80s raider phenomenon is T. Boone Pickens.
Oh, absolutely. Pickens was the 1980s corporate raider archetype for many people. He was incredibly smart, a Texas oil man, and just brilliant with the media.
Yeah.
The sources describe him vividly. Targets called him the most hated man in corporate America. But he cultivated this public image, this folksy, drawling David battling petroleum Goliaths. Very accessible style, but his tactics were razor sharp.
What was his main strategy?
He'd typically find an oil company he thought was undervalued, maybe sitting on reserves the market wasn't appreciating. He'd buy a big chunk of stock, then he'd make a very public fuss demanding changes, or just hinting he might launch a full takeover bid.
And the hope was the company would just pay him to go away.
That was often the endgame, exactly. The existing management, terrified of losing their jobs or seeing the company broken up, would buy his shares back from him at a nice premium over what he paid. That's basically greenmail. Though the sources don't always use that specific term for his actions, they describe that mechanism.
Getting paid to leave them alone.
Right. And his bid for Gulf Oil in 1984, that sent absolute shockwaves. Gulf was enormous, a pillar of the oil industry. The idea that one guy, maybe with some partners, could credibly threaten a company that size, it just stunned boardrooms everywhere.
Changes the perception of vulnerability.
Totally. Pickens apparently started deal-making young, expanding his paper route as a kid. He just scaled it up to billion-dollar oil companies. Later on, he also got heavily involved in advocating for energy policy, especially natural gas, where he had significant investments. That raised some eyebrows, too, about the line between his business interests and his public advocacy.
Interesting. Another big name, Ronald Perelman, and a really famous takeover target, Revlon.
Yes, the Revlon battle is a textbook example. A huge, well-known consumer brand caught in a very public, very nasty, hostile fight. Perelman, like Posner, operated through a holding company he controlled, McAndrews and Forbes. He decided he wanted Revlon.
So he made an offer.
Made initial offers, yes. But Revlon's board and management rejected them flat out. They didn't want him. So Perelman didn't back down. He escalated, launched hostile bids, kept raising the price, really putting the pressure on.
And this is where the white knight strategy comes in. The target tries to find a friendlier buyer.
Exactly. Revlon started looking for a rescuer, a white knight, to make a higher friendly bid and save them from Perelman, the black knight. In this case, the private equity firm Forsman Little & Company stepped up.
So a bidding war.
A fierce bidding war broke out. Lots of drama, legal maneuvers. But in the end, Perelman, through his subsidiary Pantry Pride, won control. The final price tag was around $2.7 billion.
A huge sum for the mid-'80s.
Massive. But the sources are quick to point out this buyout was troubled right from the start because of all the debt Perelman took on to do the deal.
Same pattern.
Same pattern. To handle that debt, Perelman's Revlon immediately started selling off major parts of the business. They did make some other acquisitions later, like Max Factor, but then sold those off too. It was a lot of buying and selling, driven by the need to manage that debt burden.
And the Revlon case had legal implications too.
Huge legal implications. Because it was such a high-profile fight involving a famous company, the court battles in Delaware set really important precedents for corporate law. Most famously, the Revlon duties.
Say what, basically?
Essentially, they define what a board of directors must do once it becomes clear that the company is going to be sold. At that point, the court said the board's main job, their primary duty, shifts. It's no longer about defending the company's independence. It's about getting the absolute best possible price for the shareholders.
Auctioneer mode.
Pretty much. Maximize shareholder value in the sale, which, again, highlights that tension between different goals.
Okay, so we have these aggressive players like Pickens and Perelman using massive amounts of debt, often backed by the target's own assets. Where did all this money, these billions in debt financing, actually come from? Who was funding this?
That's the crucial next piece of the puzzle. And the answer really revolves around one person and one market. Michael Milken and the rise of the junk bond market.
Junk bonds. The name alone sounds pretty negative.
Well, they are technically riskier by definition. Junk bonds is the popular term. The formal name is high-yield bonds. They're debt securities, bonds issued by companies that don't meet the quality threshold for investment grade ratings from agencies like Moody's or S&P.
Meaning there's a higher chance the company might default on the payments.
Exactly. A higher perceived risk of default compared to, say, bonds issued by blue-chip companies. So to attract investors to buy these riskier bonds, the companies had to offer a much higher interest rate, a higher yield.
High risk, high potential reward for the bond buyer. But why were they so important for the raters and the companies getting targeted?
For a lot of companies, especially medium-sized ones or those not quite hitting those top credit ratings, junk bonds were a game changer. They suddenly provided access to huge amounts of long-term debt financing directly from the public markets. Before Milken really developed this market, many of these firms were stuck relying on banks for loans, which could be more restrictive, maybe shorter term, or they just couldn't borrow large sums publicly at all.
So it opened up a new funding channel.
A massive new channel. It allowed companies to bypass the traditional bank intermediaries and tap into a much wider pool of capital from investors willing to take on more risk for higher returns.
And Michael Milken was the key architect of this market.
Absolutely central. Milken, working out of the Beverly Hills office of Drexel Burnham Lambert, didn't technically invent high-yield bonds. They existed before. But he basically transformed them from this sleepy niche corner of the market into a multi-billion-dollar powerhouse.
How did he do that?
He built this incredible network of buyers, all sorts of institutions and individuals, insurance companies, savings and loans, mutual funds, wealthy investors who he convinced were willing, even eager, to buy these high-yield bonds. This network was the key. It meant that huge sums of money, billions, could be raised very quickly to finance acquisitions.
Which is exactly what the raters and the LBO firms needed.
Precisely. KKR, Forstman Little, the raters like Icahn and Perelman, they needed fast access to massive amounts of debt to launch their bids. Milken and Drexel could provide that.
And Milken himself became incredibly wealthy and powerful.
His success was just astronomical for that time. In the late 80s, his compensation reportedly topped $1 billion over just 4 years. His influence was immense. Drexel could issue something called a highly confident letter.
What's that?
It wasn't a legally binding promise to provide the money, but it was a statement from Drexel saying that based on Milken's track record and his network, they were highly confident they could raise the billions needed for a proposed takeover.
Just the letter itself had power.
Huge power. Because of Milken's reputation, that letter was often enough to make a multi-billion-dollar hostile bid seem credible. It signaled to the target company, these guys aren't bluffing. The money is likely real. That put enormous pressure on the board.
So he wasn't just selling bonds, he was actively enabling the whole takeover boom by making the financing feasible on that scale.
You could definitely argue that. Now, supporters would say Milken and the high-yield market played a positive economic role, too.
How so?
They argued it spurred necessary corporate restructuring, moving capital away from maybe stagnant, inefficient management in older companies towards new ventures, or allowing undervalued companies to be bought, shaken up, and made more productive. It was seen as a way to bypass the old financial establishment and allocate capital more dynamically.
But there's a darker side to the story, too, right? Legal issues.
Oh, yes. Deeply controversial. The sources detail his indictment in 1989 on a whole slew of charges: racketeering, securities fraud, insider trading, market manipulation. It was a massive case.
What happened?
After very complex legal maneuvering, he ended up pleading guilty in 1990 to 6 felony counts, primarily related to securities reporting violations and aiding other wrongdoing. This plea bargain allowed him to avoid trial on the most serious charges, like racketeering, though he always maintained his innocence on many of the allegations.
But the penalties were still significant.
Extremely significant. He was sentenced to 10 years in prison, ultimately served about 22 months. He was fined an enormous amount, around $600 million, and banned from the securities industry for life.
Wow. What kind of things was he accused of doing?
The indictment alleged a range of misconduct. Things like stock parking, which is basically hiding the real ownership of stocks to manipulate markets or avoid regulations. Market manipulation, sharing confidential insider information, tax fraud. It was a long list. The sources also mentioned the controversy that the government indicted his brother, who also worked at Drexel, potentially to pressure Michael into taking the plea deal. He did receive a presidential pardon years later in 2020.
So the very financial machinery enabling these takeovers was operated by someone whose activities led to serious felony convictions. Wow. That raises big questions about the ethics and legality of the whole system back then.
Absolutely. It casts a shadow, and you have to see how directly this connected to the takeovers. Junk bonds weren't just another funding source. They became the go-to financing vehicle for hostile deals. They could replace bank loans entirely or be used alongside them.
And they fueled a lot of deals.
A huge amount. Statistics from the time, like 1988, showed a large chunk of all new junk bonds being issued were specifically to finance takeovers, or sometimes restructurings companies did defensively to avoid being taken over. But there was a downside, too. The sources point out that as the decade wore on, the quality of the companies issuing these junk bonds tended to decline. More risk was creeping into the system, which eventually contributed to problems in the junk bond market itself later on.
Okay, so companies are facing these hostile bids fueled by this new junk bond financing. They must have felt under constant attack. They couldn't just sit there passively, could they? What did they do to defend themselves?
No, they definitely couldn't just wait to become a target. The corporate world was scrambling. They needed tools, legal, and financial shields to fight back against these unwanted advances.
Like what?
A whole range of defensive tactics emerged. Things like golden parachutes, huge payouts for top executives if the company was taken over, making it more expensive for the bidder. Some companies took on more debt themselves to look less attractive, sometimes called a scorched earth defense, or the Pac-Man defense, where the target tries to turn around and acquire the raider.
Seriously?
Yeah, it happened. But probably the most famous and arguably most effective defense weapon developed was the poison pill.
The poison pill, that sounds dramatic. This was Marty Lipton's invention, the lawyer critical to short-termism.
That's the one. Marty Lipton at the law firm Wachtell Lipton is widely credited with developing the shareholder rights plan, which the media immediately dubbed the poison pill.
Okay, why poison? How did it work?
The genius of it is its deterrent effect. It's designed to make a hostile takeover incredibly expensive or even financially impossible for the bidder unless the target company's board agrees to the deal.
So it gives the board control.
Exactly. It's not meant to block all takeovers forever, but specifically to stop what Lipton saw as abusive tactics, like those lowball bids, or coercive two-tier offers where some shareholders get cash and others get junk. And crucially, it gives the board time to negotiate, time to find alternatives, time to get a better price for shareholders, or, from Lipton's view, protect the whole company.
How does it actually poison the deal? What happens?
Okay, so the classic versions worked like this. The board issues special rights to its existing shareholders. If an unwanted bidder crosses a certain ownership threshold, say they buy up 20% of the stock without the board's approval, then the pill triggers. In early flip-over versions, if the bidder then tried to merge the target company into their own, all the other target shareholders could suddenly buy shares in the bidder's company at a huge discount, maybe half price. This would massively dilute the bidder's own stock, making the deal financially disastrous for them.
I see. It ruins the economics for the attacker.
Precisely. Later versions added a flip-in feature. If the bidder just crossed that 20% threshold, even without a merger, the other target shareholders could buy more shares of the target company itself at a steep discount. This instantly dilutes the bidder's stake in the very company they're trying to take over.
So either way, the raider's stake gets watered down, making it prohibitively expensive or impossible to gain control against the board's wishes.
That's the idea. The board holds the key. They can redeem the pill, basically cancel it, for a tiny fee if they approve a friendly deal. But without that redemption, the pill is lethal to a hostile bid.
Because it was so powerful and put so much power in the board's hands, I imagine it was challenged legally right away.
Immediately. The fact that boards could implement these without a direct shareholder vote made them instantly controversial, and this led to some really critical legal battles.
And a lot of these landmark cases happened in Delaware, right? Why?
Good question. It's because a huge number of major U.S. corporations, for historical and legal reasons, choose to incorporate in Delaware. Even if their headquarters are in California or New York, their legal home is Delaware.
Okay.
So Delaware corporate law governs their internal affairs. And Delaware's specialized Court of Chancery and its Supreme Court became the main stage where the rules for takeovers and defenses like the poison pill were fought over and decided. Their rulings had nationwide impact.
So which court cases were the really pivotal ones in defining how these defenses could be used?
The sources point to a few key ones in the mid-'80s. First, there was the Unocal case in 1985. This came directly out of that Boone Pickens bid for Unocal.
The battle that sparked it.
Right. Unocal used some aggressive defenses, including an offer to buy back shares from everyone except Pickens. The Delaware Supreme Court looked at this and basically said, yes, boards do have the power to take defensive measures. They created something called the Unocal test. It says directors have a duty to protect the corporate enterprise, not just the stock price, but the whole company from reasonably perceived threats from a hostile bid. And crucially, Essentially, the court said boards are not passive instrumentalities.
Meaning they don't just have to sit there and take it, they can fight back.
Exactly. It was a big win for allowing defenses. Then, almost immediately after, came the Moran case, also 1985. This was maybe even more fundamental. It tested the legality of the poison pill itself, even when there wasn't an active takeover bid happening.
Just having the pill ready to go.
Right, as a preemptive defense. Household International had adopted one of Lipton's plans. The Delaware Supreme Court examined it and said, yes, this shareholder rights plan, this poison pill, is legally valid for a board to adopt. That decision gave the green light for companies everywhere to put pills in place.
Okay, so pills are legal, boards can defend. What about the Revlon case? We talked about the takeover, but the legal ruling was important too.
Hugely important, but it set a different kind of precedent. Remember, in the Revlon fight, the board eventually started looking for a white knight, Forceman Little. They basically put the company up for auction.
Right, the sale became inevitable.
And that's what the court focused on. The Delaware Supreme Court ruled that once a board decides to sell the company, or once a sale becomes inevitable, like in an auction scenario, their duties change. The main job is no longer defending the company's independence. It shifts entirely to getting the highest possible price for the shareholders. That's the core of the Revlon duties.
So maximize the cash payout for stockholders once you decide to sell.
Yes. Now, Marty Lipton, interestingly, was very critical of this ruling. He worried it would force boards to sell too quickly just because someone offered a high price, and it felt like judges were second-guessing the board's business judgment about long-term value versus a quick buck.
You can really see that tension playing out. Protect the company long-term versus get the best price now.
Exactly. And that tension popped up again in later cases, like Interco and Pillsbury around 1988. These cases involved companies using their poison pills to block takeover bids that weren't necessarily coercive. They were all cash, all shares, offers seemingly fair bids.
So not the tricky two-tier offers from earlier.
Right. And Chancellor Allen, a highly respected judge in Delaware's Court of Chancery, issued rulings suggesting that maybe a board couldn't use the pill indefinitely to block a fair, non-coercive, fully financed cash offer if the only reason was to stop shareholders from accepting a good price. The idea was maybe at some point the shareholders should get to decide.
So the courts were trying to find the right balance, the limits of the board's power with the pill.
Absolutely. It was this ongoing legal refinement. Lipton worried these later rulings were dangerous, again pushing boards toward short-term thinking, letting judges make business calls, and potentially fueling the takeover frenzy by signaling that any high-cash offer might eventually force a sale, regardless of the board's view on long-term strategy. He feared companies might take on risky debt or slash R&D just to avoid looking like a target.
So after all these legal challenges and refinements, what was the ultimate impact of the poison pill? Did it work?
Well, from Lipton's perspective, presented in the sources, yes, it was remarkably successful despite the legal headwinds. He argued that by the late 80s, the pill had effectively shut down the most abusive tactics from the early part of the decade, those coercive two-tier offers, street sweeps, where bidders rapidly bought up stock just under the trigger point. He saw the pill as a shield against those abuses. And in situations where a sale was the right move, or became inevitable under Revlon, he saw the pill as a gavel, a tool that gave the board crucial negotiating leverage to hammer out the highest possible price for shareholders. It restored bargaining power that boards simply didn't have in the early 80s, and its adoption was widespread by the end of the decade. Hundreds, maybe close to 1,000 companies had poison pills in place.
It really sounds like these legal fights were just the surface manifestation of a much deeper conflict. Not just about finance law, but about fundamental questions like what is a corporation? Who is it supposed to serve?
That is absolutely the heart of the matter, the underlying philosophical battle of the era. Figures like Marty Lipton were arguing forcefully that the whole takeover boom was a dangerous symptom of short-termism, poisoning the well of corporate decision-making. That farmer analogy he used, it wasn't just rhetoric. It reflected his deep belief that prioritizing immediate financial extraction over long-term investment in health was ultimately suicidal for the company and bad for the economy as a whole.
And he had this alternative idea, the enterprise theory.
Yes. Lipton argued against the dominant view that corporations exist solely to maximize shareholder value. He believed they should be managed for the benefit of the entire enterprise. That means considering the interests not just of shareholders, who he often saw as temporary holders of stock, but also employees, customers, suppliers, and the communities where the company operates.
All the stakeholders.
Exactly. He felt the narrow shareholders-only focus reinforced by legal ideas like the Revlon duties, ignored the reality that all these groups contribute to the company's success, share its risks, and have a legitimate stake in its long-term survival and prosperity.
So who did Lipton see as pushing this short-term shareholders-only view so hard?
He pointed a very direct finger at institutional investors, pension funds, mutual funds, insurance companies. He called it the age of finance corporatism. He saw these massive pools of capital managed by professionals focused on quarterly performance numbers as the primary force fueling the leveraged takeover wave.
Why them specific?
Because they controlled so much stock. Their decisions to buy or sell could move markets and put immense pressure on companies. He made this really striking comment, quoted in the sources. "Never in the history of our modern economic development has so much economic power been held by so few." He meant these institutional fund managers.
It seems a bit strange, though. You think of pension funds needing long-term returns. Why would they push for short-term actions?
That was exactly Lipton's point about misaligned incentives. He argued that the managers of these funds, the professionals making the day-to-day investment decisions, often felt intense pressure to beat benchmarks and competitors each quarter. Their compensation might even depend on it.
So the manager's short-term goals might not match the pension fund's long-term needs.
Precisely. So Lipton argued if a company made a big long-term investment in R&D that might depress earnings for a few quarters, that could make its stock underperform temporarily. The fund manager, fearing they'll look bad or even lose their job, might sell the stock, or worse, support a raider who promises a quick pop in the stock price through restructuring or a takeover premium.
So management is caught in a bind. Plan long-term and risk looking bad short-term, potentially attracting a raider. Or focus on quarterly numbers to keep the institutions happy, even if it means sacrificing the future.
That's the dilemma he described. And he felt the fund managers themselves, driven by these competitive pressures and compensation structures, were acting more like speculators, chasing quick profits than true long-term investors. He argued they'd readily take any takeover premium offered, even if it meant dismantling a perfectly viable company, and sometimes they'd even actively join the raiders in pushing for a deal rather than supporting management's long-term plan. Their interests, he felt, weren't aligned with the ultimate beneficiaries of the funds, let alone the companies.
And these institutions didn't just passively influence things. They actively fought against defenses like the poison pill.
They did. Major institutions like CalPERS, the California Public Employees Pension Fund, and TAA, CRF, the Teachers Retirement Fund, became leaders in what Lipton called the anti-pill campaign. They used shareholder proposals, proxy fights, and lobbying efforts to try and dismantle takeover defenses, especially the poison pill.
Arguing for shareholder rights, presumably.
Yes, framing it as corporate governance reform. But Lipton saw it differently. He viewed it as these short-term focused speculators acting in their own self-interest, getting quick premiums, boosting quarterly returns, dressing it up as high-minded governance reform. While their early efforts to get shareholders to vote against pills were mostly defeated around 1987, it really marked the beginning of large-scale institutional shareholder activism targeting corporate defenses.
So if Lipton thought their incentives were skewed, what was his alternative? How should these powerful institutions behave?
He had a vision for them as potential providers of patient capital. He believed that if their incentives could somehow be realigned, maybe, he mused, through something like a tax on short-term trading profits, though he admitted that was politically difficult, they could become constructive partners with management.
How so?
They could support long-term business strategies, bridge the gap between dispersed ownership and professional managers, and enable a form of shareholder democracy that was actually focused on building sustainable value over time, not just flipping stocks for quarterly gains. He argued this shift from short-term trading to long-term growth focus would ultimately be better for everyone, the investors, the companies, and the overall health of the economy. It would align their interests more with the country's general prosperity.
It's a compelling critique. It suggests the issue wasn't just a few rogue raiders, but maybe deeper structural incentives within the financial system itself.
Oh.
So looking back, how did this whole intense period of 80s raiders and Black Knights actually wind down? Did they just disappear?
Well, the peak era, that classic 1980s style of corporate raiding, did decline quite a bit by the late 80s and early 90s. There wasn't one single cause, but a combination of factors.
Like what?
For one, some of those highly leveraged deals just didn't work out. Raiders overpaid or the debt burden proved too much, leading to bankruptcies and losses, which cooled some enthusiasm. Critically, the fall of Michael Milken and Drexel Burnham Lambert really choked off the easy supply of junk bond financing that had fueled so many bids.
The engine ran out of gas.
In a way, yes. Plus, the widespread adoption of defenses like the poison pill made hostile takeovers much harder, riskier, and more expensive. And then the stock market started rising significantly in the 90s, meaning fewer companies looked dirt cheap and obviously undervalued, reducing the number of tempting targets for that quick-hit financial play.
But the underlying idea of outside investors trying to influence companies didn't vanish, did it?
Not at all. It evolved. The sources point out that the mantle was kind of picked up by what we now call activist shareholders or hedge fund activists.
How are they different from the 80s raiders?
There's still large investors buying significant stakes to push for change. But the goal isn't always a full hostile takeover and breakup like in the 80s. Often they focus on influencing the board, pressuring management for specific actions, maybe spinning off a division, changing capital allocation, improving corporate governance, replacing the CEO. It's more about activism from within, or the threat of it, rather than just outright hostile acquisition as the main tool. This really grew in the 90s, building on those 80s debates about shareholder rights.
So how do today's activists compare? Are there similarities, differences?
Both. On the similarity side, today's activists are often huge, sophisticated operations themselves, big hedge funds with immense resources, top lawyers, PR firms. They can launch incredibly comprehensive campaigns that can really put a target company on the defensive. And they still often target companies they see as underperforming or having sloppy corporate governance, which echoes the criticisms from the 80s.
Okay, and the differences?
The overall ecosystem is different. Private equity, which emerged from the LBO boom, is now a massive global industry, way bigger than in 1980. Leverage is still key, but some sources suggest maybe the average leverage levels aren't quite as extreme as in some infamous 80s deals like RJR Nabisco, maybe leading to slightly lower bankruptcy rates for PE-backed firms now compared to back then, although that's debated, and competition is way fiercer today.
And you mentioned earlier the way the fund managers get paid changed too.
Right. That's a big evolution noted in the sources. Back in the 80s, LBO managers often got deal-by-deal carried interest. They could make huge money on one successful deal, even if others in their fund lost money. That potentially incentivized taking massive risks on individual deals.
I see.
Now it's mostly fund-based compensation. Managers get performance fees based on the overall success of the entire fund, usually after clearing a minimum return threshold for investors. This generally aligns the manager's GP's interests better with the investor's LPs.
So better alignment? Maybe fewer incentives for reckless single deals? But maybe new issues?
Potentially. The sources mention that because fixed management fees, often just a percentage of the total money managed, assets under management, or AUM, have become such a large part of PE firm revenue compared to performance fees, there might be a subtle incentive shift, maybe more focus on just growing the size of the fund to collect more management fees rather than solely focusing on maximizing returns. It's a different dynamic.
Thinking about that RJR Nabisco deal, which everyone knows from Barbarians at the Gate, that feels like the peak, almost caricature, of the 80s LBO, massive debt, huge egos. Today's activism or PE deals seem maybe more refined, even is still aggressive.
Yeah, RJR Nabisco is often seen as the high watermark, maybe the cautionary tale of that specific 80s model with its extreme leverage. Today's activists and PE firms are certainly aggressive, and leverage is still crucial, but the strategies, the financing, the regulatory environment, the whole landscape has evolved. But that fundamental tension, the clash over time, Horizon's activists wanting quick results, management needing time for long-term bets like R&D, that absolutely still exists today.
Okay, let's wrap up this deep dive. It's been a fascinating journey back to the 1980s takeover scene in the U.S. We saw hostile bids explode, powered by things like bootstrap debt and Michael Milken's junk bond market. We met the famous, often feared Black Knights and corporate raiders. We saw companies fight back with poison pills, leading to major legal battles in Delaware that reshaped corporate law. And underneath it all, this profound conflict emerged. Short-term financial gain versus long-term corporate health. Shareholders versus stakeholders, fueled by the growing power and specific incentives of institutional investors.
That really covers it. I think the key takeaways are pretty clear. The incredible power, but also the real dangers of financial leverage. That fundamental ongoing debate about what a corporation is actually for just shareholder profit or something broader.
Yeah.
And that persistent tension between investor demands for immediate results and management's need to invest for the future. Plus, how finance and law constantly interact to reshape the business world.
It really makes you think. When you look at how those 80s raiders morphed into today's sophisticated activist funds, and we're still debating short-termism, governance, the role of finance, has that basic conflict over who really controls companies and for whose benefit actually been resolved? Or does the spirit of the 1980s Black Knight, maybe less swashbuckling but still focused on financial engineering and quick value, just wear a more expensive suit today?
That's a great question, and it's one that people in boardrooms and on Wall Street are still grappling with every day.
A really insightful look back at a truly defining era for American business. Thanks so much for walking us through it.
My pleasure. Always interesting stuff.
We'll get you next time for another deep dive into the stories behind the headlines.